Imagine a company whose stock trades at $90 a share, whose market cap tops $60 billion, and which Fortune magazine names the most innovative company in America 6 years running. A company so admired that business schools taught it as a model, and young graduates fought for a job there the way they'd fight for a spot at Goldman Sachs. Now imagine that 3 weeks after its first real problem surface, nothing is left of it. Not the company, not its employees' savings, not the trust of an entire industry. This isn't a hypothetical. This is Enron. And it's a story about how you can fool the whole world if you do it with enough confidence and for long enough that everyone stops asking questions. It all started out boring. Enron was formed in 1985 from the merger of two ordinary natural gas pipeline companies in Texas. Pipelines, storage, delivery, nothing remarkable about it. The kind of business that makes steady, unglamorous money for decades. But through the 1990s, CEO Kenneth Lay and President Jeffrey Skilling decided a pipeline company wasn't ambitious enough. The real money, they believed, was in trading. So Enron transformed itself into something closer to an investment bank than a utility. A company that traded energy contracts the way Wall Street trades derivatives. Gas and electricity were just the beginning. Enron went on to sell internet bandwidth, weather risk, even the right to future rainfall, essentially any kind of volatility that could be packaged into a contract and sold to someone else. By the end of the decade, Enron was calling itself the world's leading company, and by revenue it briefly ranked among the 7 largest corporations in America. There was just one problem. A large part of this empire existed only on paper. A normal company books profit when it actually receives money for goods or services delivered. Enron did things differently. Starting in the early 1990s with the SEC's approval, the company adopted what's called mark-to-market accounting for its trading contracts. Under this method, Enron began recording the entire projected revenue of multi-year contracts as profit. The moment the contract was signed, not when it was fulfilled. Sign a 20-year gas supply deal and Enron could immediately book its whole projected value as profit, all at once in that quarter's earnings. Even if the actual cash wouldn't arrive for a decade. Even if the market shifted and the deal turned out to be worth far less than projected. A forecast became profit right then and there. And if reality later diverged from that forecast, it barely mattered on paper. The gain had already been booked, already celebrated, already baked into the stock price. This gave Enron's executives an enormous incentive to sign more contracts, bigger contracts, and to make the underlying projections as rosy as possible. The business model wasn't really about delivering energy anymore. It was about generating numbers that Wall Street would reward. But not every project could be dressed up with an optimistic forecast. Some were genuinely losing money from day one. Power plants overseas that never turned a profit. A fiber optic broadband venture that was years ahead of any real demand. International projects tangled in local politics and currency risk. These couldn't be disguised with forecasts. The losses were real, and if they showed up on Enron's balance sheet, the stock would take a direct hit. So CFO Andrew Fastow came up with a fix. He built a web of thousands of specially created shell entities, so-called special purpose entities, with names like Chuco, JEDI, LJM, and Raptor. On paper, these were independent companies. In practice, they were a dumping ground. Places to offload Enron's underperforming assets and mounting debts, so none of it had to appear on the company's main balance sheet. The wildest part of the scheme was the conflict of interest at its core. Fastow personally ran several of these entities himself and used them to enrich himself by tens of millions of dollars, money that came, one way or another, out of Enron's own value. The company's board of directors knew about this arrangement and approved it anyway, waiving its own conflict of interest rules to let it happen. By 2001, Enron was reporting billions of dollars in profit on paper, while quietly carrying almost as much in real, hidden debt inside this shadow network of partnerships. The cracks started to show earlier than most people realized. In the summer of 2001, Jeffrey Skilling, who had only been CEO for about 6 months, abruptly resigned, citing vague personal reasons. He had spent years as the architect of Enron's trading culture and its aggressive accounting. His sudden exit, with no real explanation, made the market nervous for the first time. Around that same period, Enron Vice President Sharon Watkins wrote an anonymous memo to Kenneth Lay, warning him directly that the accounting used in the SP partnerships could cause the company to, in her words, implode in a wave of accounting scandals. Lay met with her, had internal reviews conducted, and ultimately did nothing to unwind the structures she was warning him about. By that fall, outsiders were asking the same uncomfortable question insiders had been avoiding. Fortune reporter Bethany McLean published an article bluntly titled, "Is Enron Overpriced?" built around one simple, damning observation. Nobody outside the company, and apparently few people inside it, could clearly explain exactly how Enron made its money. Stock analysts who had rated Enron a buy for years suddenly found they couldn't answer the question either. On October 16, 2001, Enron announced a $618 million quarterly loss and a $1.2 billion write-down of shareholder equity, tied directly to the unwinding of Fasthouse partnerships. It was the first time the public saw hard numbers instead of vague reassurances. The SEC opened a formal investigation days later. The stock, which had traded above $80 at the start of the year, kept sliding week after week. In November, Enron admitted something far worse. It had overstated its profits by nearly $600 million over the previous 5 years and needed to restate years of financial statements. Credit rating agencies, watching the company's finances unravel in real time, downgraded Enron's debt one notch after another until it hit junk status. And under the fine print of many of Enron's own trading contracts, a credit downgrade like that automatically triggered clauses demanding immediate repayment of billions of dollars in debt, all at once. A last-ditch rescue merger with rival energy trader Dynegy was announced, then collapsed within weeks, once Dynegy's own accountants got a clear look at the size of Enron's hidden obligations. On December 2, 2001, Enron filed for bankruptcy. At the time, the largest corporate bankruptcy in U.S. history. A company that, just 12 months earlier, had been worth more than $60 billion was reduced to nothing in a matter of weeks. More than 20,000 employees lost their jobs almost overnight, many of them escorted out of Enron's Houston headquarters with their belongings in cardboard boxes, live on national television. And along with their jobs, many lost the bulk of their retirement savings that Enron's own retirement plan had encouraged, and at times required, employees to hold in company stock, even as executives were quietly selling their own shares. Enron's outside auditor, Arthur Andersen, one of the big 5 accounting firms in the world at the time, made things worse for itself. As federal investigators closed in, staff at the firm shredded thousands of documents related to their audits of Enron in an attempt to destroy evidence. That decision cost Arthur Andersen its license to practice and ultimately its existence. A firm with nearly 90 years of history and roughly 85,000 employees worldwide effectively ceased to exist within months, collateral damage from a scandal that wasn't even its own. The people responsible faced consequences, though not always equal ones. Andrew Fastow pleaded guilty to fraud charges and received 6 years in prison after agreeing to cooperate extensively with prosecutors and testify against his former colleagues. Jeffrey Skilling was convicted on multiple counts of fraud and conspiracy and originally sentenced to 24 years in prison, one of the harshest white-collar sentences in U.S. history at the time. That sentence was later reduced on appeal, and Skilling was released in 2019. Kenneth Lay, the company's founder and longtime chairman, was convicted on all charges against him, but he died of a heart attack just weeks later before he could be sentenced, and his conviction was ultimately vacated under a legal doctrine that applies when a defendant dies before appeals are exhausted. Enron's collapse wasn't just the largest bankruptcy of its era. It changed the rules of the game for corporate America. In 2002, Congress passed the Sarbanes-Oxley Act, one of the most sweeping reforms of corporate governance and financial reporting in U.S. history. It tightened auditing requirements, restricted the kinds of consulting work an auditor could do for a client it also audited, and, for the first time, made corporate executives personally sign off on and be held criminally liable for the accuracy of their company's financial statements. Enron didn't steal money in the usual sense of the word. It stole trust. Trust in the numbers, trust in the reporting, trust in the basic idea that a public company is obligated to tell the truth about what it's actually worth. And once that trust was gone, the empire went with it. An organization that took decades to build and that once employed over 20,000 people across the globe unraveled in a matter of weeks. Not because a competitor beat it, not because the market turned against its business, but because the numbers it had been showing the world were never real to begin with.